Today's episode of The Unlock is sponsored by Wealthbox, the #1 rated CRM software for financial advisors. If you're using some other clunky CRM software, check out Wealthbox, where tens of thousands of advisors have made the switch. Our advisors use CRM all the time for client alerts and keeping track of compliance and taking notes for clients. It's a huge part of your everyday business as an advisor. If you want to experience it firsthand, sign up for a free trial or schedule a one-on-one demo to see how Wealthbox can transform your business to help grow and retain clients. Visit wealthbox.com to get started. Welcome back to The Unlock, the channel we built exclusively for financial advisors. This is Ben with Benefits. I'm joined today by Fred Barstein. Fred works at the Retirement Advisor University. Fred, welcome to the show.
Thanks for having me, Ben.
So I've been talking about the $12 trillion opportunity. That's about the amount people estimate that is involved in the defined contribution retirement space. A handful of advisors came to me after I wrote about this and talked about it and said, why do I need to care about 401k plans in the first place? My business is just fine without them. What do you say as an expert in this space? What do you say to someone who gives you that pushback?
First of all, what we're seeing is wealth advisors who also have a few plans at least are more profitable because they feed each other and they work very well together. So on the one hand, I agree. If you're only looking at the fees that you can get from the 401k at the plan level, it doesn't make a lot of sense. But they really feed each other. As you said, it's hard to ignore $12 trillion with $1 trillion a year rolling out of those plans and catching the IRA. So it's the kind of thing is you can't really expect that you're going to get that rollover money unless you have some relationship with the people that are rolling out of it. So yeah, you might have clients in the 401k, but if you are the advisor, you have access to them. So it's really about the rollover, but it's also about, maybe there's another 2, 3, 5, 10 other people at the company who you could convert to wealth clients, especially what's called Henrys, high earners, not rich yet. If you can form a relationship with someone who's making $150,000, $200,000, $300,000 a year, but doesn't have the assets, when they do, you're going to be the one of it. So there's a lot of reasons, but those are the top.
So you mentioned the rollovers. And again, I think it was last year, like $1 billion came over in rollovers. And I think some advisors just assume the retirement plan sponsors are going to be thinking like, hey, we're keeping these assets nice and warm for you. We're just going to hand them over to you once these people hit retirement. Go ahead and take them. Plan sponsors obviously realize, wait a minute, this is a lucrative business for us too. Why don't we try to keep this money? So how is the competition in this market heating up from the plan sponsor side of things versus the advisors?
Yeah. And first of all, it's not $1 billion, it's $1 trillion. So it's a little different.
Yeah, right. A lot of money.
The plan sponsors aren't the competition for the wealth advisors. Plan sponsors, some of them and more want to retain the assets because if they have the big accounts, it makes their plan, there's more money in the plan, they have more leverage, and they get better deals because they have scale, but they're not making money off of it. Who you're competing with are the record keepers who do this business. So the Fidelities, now the Empowers, the Vanguards, the Voyas, the Principals, T. Rowe, they are also in the business of trying to capture those rollovers. So you're competing against them. And if they're the record keeper, there's a huge advantage. They have brand. They also know when that person is separating from the company. And then the other competition.
Oh, right, because it's all recorded, right? They know what's happening.
They know. Yeah, because they're saying, oh, yeah, this person's terminated. The other is, the retirement plan advisors, right? If you're like just expecting to sit on the other end of a company outside the company's doors, metaphorically, there's advisors, retirement plan advisors who are there trying to figure out how to do this themselves. So, what we find is the rollover advisors who have a relationship already because they're managing their assets outside of the 401k plan, not only do they get a greater percentage, but the accounts are higher. The advisors who don't, they're much, much smaller accounts and they have a less chance of getting that business.
So you mentioned Empower, and there's been some M&A in this space in recent years. So Empower bought Personal Capital a few years ago.
Yeah.
I think that was right at the outset of 2020. Creative Planning joined forces with Lockton.
Yeah.
Both of these moves, I guess, were made to, like you said, grab a stronghold there and offer advice to people while they're in the retirement plan and potentially bring them over as full-time wealth management clients. Are we going to see more transactions like this in the years ahead?
Yes, no doubt. You also saw Hightower bought NEPC. NEPC is a $1.6 trillion institutional investment consultant. So they're managing larger plans, but also foundations and endowments. And Mariner just recently announced the acquisition of Cardinal Investment Advisors with $278 billion. The biggest thing happening in the 401k world, which is now touching a couple of things. Number one is the convergence of wealth, retirement, and benefits at the workplace. Plan sponsors and people want their advisor at the retirement plan where you have access to data and relationships. Oh, can you help me with financial planning, with wealth management, with other things? So those are very lucrative potential opportunities. So convergence is one. Second is the explosion of 401k plans, estimated to go from 600,000 401k alone to a million plans in the next 5 or 6 years, because states like California, Oregon, Illinois, and there's almost 40 of them who are either considering, are mandating that companies of a certain size have a retirement plan. Now, their option is an auto IRA. But then the company might say, why don't I just do a 401k? So you've got the explosion. I mean, it's just unprecedented, 50% increase. And then the third thing you're seeing, and you mentioned it, is consolidation and M&A. Empower, the senior executives of Empower all came from Fidelity, and they saw how lucrative it was for Fidelity to leverage those relationships of the participants in their 401k plan to do other wealth services. So that was what Personal Capital was about, getting that capability. What you mentioned with Creative Planning and Lockton is an RIA aggregator saying, if we had access to participants in plans, we could leverage our wealth and financial services, financial planning capabilities on hundreds of thousands, if not million, because Lockton had $120 billion when they were bought by Creative Planning. So this consolidation of record keepers, advisors, RAs, RPAs is heating up and is not going anywhere.
So you've mentioned a lot of really gigantic firms, and obviously it makes sense that these firms would be well positioned to take advantage of this. Fidelity and Empower and Creative Planning. What about, we have a bunch of smaller RIAs that follow us. What do they do? Is it a much higher hurdle for them? How do they get a foothold in this industry?
So an RIA who's looking at doing retirement and a retirement plan advisor who's looking at doing wealth, they have three options. They can build, buy, or partner. Building is the hardest, right? Those of your smaller firms that don't have an understanding or resources or knowledge, people that know this industry, to create it from scratch is very, very difficult. Probably easiest is to partner. You got an RIA firm that partners with an RPA firm that really doesn't have the wealth management. And again, they're in the same boat, build, buy, partner. Easiest thing is to find a compatible group that's local. And then the other, which is actually happening quite a bit, is, acquiring or merging, that's the best, because now you're merged, you're one firm. That's what smaller firms are not going to compete with Creative Planning and Empower, who are, different on it, but it's happening at a small scale. It doesn't have to be at a big scale only.
And tell me about how the financial advice space has gone on inside of these plans. That's something that in the past maybe wasn't offered to everyone. How often is that an option now for people to actually get advice, not just a suite of funds or maybe a target date fund or maybe an asset allocation, but they're also
Right.
getting financial advice? How often is that the case these days?
Not as much as the press would like it to be. It
Oh,
is
really? Okay.
a big buzzword. Financial wellness.
Yes, wellness is the word. You're right.
It is the word. And if you ask 10 people what financial wellness means, you'll get 10 different answers.
Yeah.
Um, if you ask, but we all know what financial illness looks like. So we're trying to solve for that. There's a lot of money being thrown at it. There's a lot of the plan sponsors want it, right? They don't. They want an advisor now, and we're doing advisor RFPs. So if plan sponsors come to us and say, "Hey, we're looking for a new advisor," and we do a process with them, they're asking for what tools do you have? What are you doing to help our employees? And it's not just the high net worth, right? It's like the masses, and how do you do that? So what we're finding is just like with AI is not going to replace advisors, but it'll enable advisors and give them more. So there is a lot of that technology. The problem is with 401k engagement, right? How do you get people to engage with that tool, give you data? And the engagement is less than 10%. So we're early stages on that. But the demand is there. The demand from plan sponsors to have advisors offer that, but also the demand by participants to say, just like if all you're doing is advising on the 401k, they just put them in a target date fund. Now you're done, right?
Yeah, simple.
We are seeing, and this is part of it, managed accounts. Managed accounts is really proliferating. Advisor managed accounts. Why? Because the advisor doesn't want to change the managed account when they change record keepers. Let's say they move a plan, plus there's additional revenue, which is always important. Managed accounts are really that, if I can engage them to say, hey, tell me a little bit about yourself. There's information that the record keeper has about their salary, their account balance, and things like that. You can change and upgrade the managed account. But even better if you can get outside assets, but also engage in that. So managed accounts are part of that. And then on the other end, as people retire, there is what's called retirement income solutions. As people get closer,
that stuff is going to explode in the years ahead, isn't it? It has to.
The retirement income is not a question of if, it's a question of when. They're just huge barriers inside of the 401k ecosystem that have really limited adoption. Part of that is it's record keepers don't cooperate if you want to transfer the guarantee from one to another. Plan sponsors have to be willing to want to retain the assets, right? If it's an in-plan retirement guaranteed income solution, there's costs around, and transparency around annuities, which is the biggest thing. But there's a lot of momentum, a lot of interest, especially, again, $12 trillion attracts a lot of people. And it's also very sticky money. So that's a part. You have the rollovers, you have the managed accounts, you have the retirement income. Those are probably three of the most tangible things. Financial planning is a little squishier. And a lot of the people, reality is that they don't have enough money to do financial planning, right? My estimate is 97% of participants in a DC like 401k or 403b do not have an advisor. They do not have it. And we're talking about 83 million people. It's a big number.
That makes sense. And I like your take earlier about the Henrys and trying to get a foothold there, because these are high earners who are going to eventually be growing money. And they have money outside of their 401k too, right? They have IRAs, they have brokerage accounts, they have all this stuff. And one of the hurdles in the past has been, well, I can't really manage these 401k assets, so it's not worth it to me. So I guess that's your point about getting in there and working as a sponsor or working as the retirement planning to get into these, and so you can get that other 3%, I guess, essentially, right? And I guess that kind of gets back to your thing. I want to circle back to what you said earlier that the advisors who have this retirement plan arm are more profitable. I'm kind of curious to hear your take on that, but that's the idea. Then you want to get into this space because that way you can have more of a say over the assets and the managed accounts and that sort of thing.
Yeah, so you got the Henrys and you got to take a long view, right? If you're like, hey, I just want to make money this quarter, Henrys are not going to do it for you. But if, the firms like Carson and others that I've talked to, they're like, hey, we're taking a long view on this. And you have the Henrys. Also, 50% of all wealth is hidden, is unadvised, right? So you have people that sold their house or inherited money, and you're not your profile of your typical mass affluent or high net worth. You can find them inside of the DC plan. And the feeding of it, there's been research. I think LPL did some research and on that the advisors that have even a few retirement plans are more profitable that have none. One of my best friends, who's now the head of one of the big RPA aggregators, when I met him, he had his biggest business was retirement, but he had a 7-figure advisor, who was doing wealth, and it was all being fed. 90% was being fed by the retirement plan on that. So, and it is not 3%. It's like 97% don't have an advisor. Now, you're not going to be the advisor to all of them, but if you can get another 3%, so 3% of 80 million is, 2.5 million people, right?
Yeah.
And 10% it's big numbers. And Jamie Gorman, who was the former CEO of Morgan Stanley, predicted that in the next 10 years, the workplace will be the number one place where advisors gather assets.
That was shocking to me. In one of his last earnings calls, he said, this is our growth engine here, which you would never expect to hear from Morgan Stanley, right? He's saying retirement plan space, that's where we're going to see our growth in the next decade. I'm curious, you mentioned a few of the things advisors can do. What do you think about the educational component? So our retirement plan specialist, Dan LaRosa, he does these educational seminars occasionally for the plans. I've done a handful of them, over Zoom to a group of people who have our 401k and the other participants. Do you think that's helpful at all in terms of like getting in front of people and trying to, you're not doing financial planning, but you're trying to educate people and really become front of mind when they actually need financial planning in the future?
I think that education, of participants, and that's what you're talking about, it's got to be a combination of group education, and that's education, right? You can't really, there's education, guidance, advice, and then at the highest level, you just do it for them, right? You have discretion. Those are important, but just to get branding awareness, what we find is the most valuable or the most successful are you do a group meeting and you offer one-on-ones right afterwards. So you're meeting individually. And then we do think that technology enables that, but we think AI is going to be the big, right now the technology is not as robust as it could be to enable that. So I think that is very, very important. You can't give up on that.
So you've mentioned AI a couple times. We've had plenty of discussions with our advisors on the potential for it and how it could make their lives easier. Where do you think you see it helping advisors the most in something like this?
Yeah. So, there's all the AI stuff around, process and being more efficient. Where I'm focused more on is how do you scale advice to the masses, right? How do you use AI to get to people that really you can't meet with more than 3 or 4 times a year for a half hour, that don't have the assets yet to be able to justify that customized, personalized touch. That's where we see AI enabling. But first, you need the relationship, and then you need the advisor, be there who can maybe have a tenfold. They can talk to 10 times more people than with AI than they can without the use of technology.
Yeah, I've gotten a lot of questions from people over the last couple of years saying, do you think AI is going to replace advisors? And I think it's going to make them more efficient. But To your point, I think AI is going to help the people who don't typically have access to an advisor and don't really use it. I think that's where the biggest gains are going to be felt. Those people are going to see enormous benefit from this.
And where are they? They have retirement plans, and more because of the explosion from 600,000 to a million 401k plans. That's why Jamie Gorman is not saying you can make a lot of money by managing a 401k. That's not what he's saying. What you're saying is if you have the 401k and you are the advisor, you're going to gather assets, not your traditional assets from your high net worth and mass affluent, but the Henrys, the hidden wealth, forming relationships and building this immense pipeline, because you do have data. There is data on those record keeping systems. Now, data is another very controversial issue. Can you use the data? Do you need permission? How clean is the data? How extensive? But, data is the oil. You can have a great machine, great Ferrari out in front of you, but if you don't have any gas, you ain't going anywhere. And the data is really important.
And the other thing about the Henrys, why I think it's so important to play to that group, is because I've seen this firsthand. A lot of the baby boomers, they have all the money. They're not spending it as much as they should. And they're going to pass those, I don't know what the estimate is, 30 trillion or 50 trillion or 80 trillion, whatever the number is. That number is getting passed down to the Henrys eventually, right?
That's
a
right.
lot of it is. And having them, when they have that life event, then they're going to be looking for someone to give them financial advice once they have that money come in.
Yeah.
I'm curious, what is it that you're doing at the Retirement Advisor University to help advisors in this space?
Yeah, so we started in 2010. It was a collaboration. Collaborated with UCLA Anderson School of Management, their executive ed, because we wanted to do a high level training program. It's on campus at UCLA. It's a 3-day program there, and the benefit not only of the education is you get to use UCLA in your LinkedIn and bio. We also have an online certification that we partner with Spark, which is the Association of Record Keepers. So we do a lot of, training and certification, and we think that the Spark designation is really good for the wealth advisor. It's an online. But the biggest thing that we're doing in education is we're training plan sponsors. So we do half-day training programs with plan sponsors, 25 or 30 at a time. But then we partner with a local advisor. So the advisor works with us and is sort of the main trainer, but now they're in front of 25 to 30 prospects. And the demand for education among plan sponsors because of the growing importance of retirement plans. So that's our sister company, TPSU, the Plan Sponsor University, but we work exclusively with advisors to do that. So we partner with one per territory. So the training is, immense, more among the plan sponsors. And eventually, as you mentioned, the biggest pool is the participant. We haven't gotten into that realm yet.
So what I mentioned, we have a wide range of advisors who listen to this show. What size advisors are you working with with these plan sponsors?
So when we work with the plan sponsors, we tend to work with the more elite advisors who have experience, and they're also have a very robust book of business because a lot of them leverage their investment and record keeping partners to help subsidize the cost of that program. So on the TPSU program, we tend to have the elite, but there's a lot of RIAs out there who don't specialize in this business, but have, hundreds of millions of dollars of DC assets, and they're trying to build that book of business. So we're willing to work with them. I mean, if they're just starting out and they don't know anything, it's going to be very difficult. But we're seeing a lot of, a good friend of mine just went over to an RIA, smaller, regional RIA aggregator, and he's a retirement specialist. And so they're bringing these people in. Savant Wealth just hired one, a retirement, because they want that person with the knowledge. And that person is a great TPSU, we call them adjunct lecturer.
So I give this presentation. I've talked to a number of different advisor groups, and I call it like the evolution of financial advice. And I kind of do a history of the products and service models. And I think one of the cool things about going on that undertaking and studying the past of financial advice is just how far we've come. You know, advisors have gone from, you know, stock picking to, hey, we just give you a salad of mutual funds and that's it. And now it's financial planning, and now it's so much more comprehensive. And now you have all these other asset access points where the big advisors are moving downstream. And that's something that never would have happened, I don't know, 10, 15, 20 years ago. And so I just think it's really cool to see the evolution of the industry in this way, where you're saying your tentacles have to be, if you're going to, you know, make it in this business, you have to be touching all these different areas if you want to continue to grow.
It is, and I remember, especially the higher level advisors, RIAs, 60, 70, 80% of their clients own or run a business. And, you know, this is not like, hey, I'm going to specialize and focus entirely on 401k. It's one of the many tools, because as you said, it's no longer about stock picking. It's like all the different services, almost like a mini family office that you offer this wealth client. And if you don't do it, somebody else is going to do it. And you may not like another advisor in there managing your client's 401k, because what are they looking for? They want to manage the wealth of that client. So,
and it often comes from, you know, surprising places. We have retirement plans that we work with who will say, hey, you guys have done a great job here. I'm also on the board at this nonprofit. Would you come talk to us about this nonprofit? And by the way, the nonprofit, they have a 401k or 403b as well. So maybe you could talk about that. And then some of the people on the board for that, maybe they'll be clients. And so it often kind of snowballs, and it might not work as you assume to get these clients, but just giving yourself the at-bats there gives you a much wider funnel for opportunity sets.
And private equity too, you know, because less companies going IPO, more of them private equity. If you get in with a private equity firm and they like what you're doing with one of their portfolio companies, they might have 10, 20, 30 others that you will get into. It's hard. I can't make the argument that all RIAs should become RPA specialists, but I will make the argument that RIAs that don't pay attention will lag behind the colleagues that do at least some, and, you know, have a foot in the 401k market.
That makes sense. Fred, if advisors want to learn more about your Retirement Advisor University, where do we send them?
Yeah, so that would be under trauniversity.com, and all of the services and certifications, even the plan sponsor training is right there. So it's TRA University, or they can email me at fred@trauniversity.com.
Perfect. Appreciate you coming on the show. This was great. If you're an advisor, subscribe to our newsletter at advisorunlock.com. We're sharing everything you need to know about our business, how to get ahead, how to stay ahead. Subscribe to this channel so you can hear great conversations like the one we just had with Fred. And we'll see you next time. Thanks, everyone.
Thank you for having me, Ben.